if you look at the bottom, it's got time and the date there and such like, but point and figure is purely price action.
Well, here we are. Welcome everybody. Welcome traders. Hope you're well. I'm here with Chris. Before we go into the webinar, please, traders, guys, change your settings on your chat so everyone can see what you type, not only hosts and panelists. That way, everyone can see your questions and we can have like a more fluent conversation. Now, I'm here with Chris Tubby. Chris, we met like 1 month ago at the event in London. It was a lot of fun and a lot of content, and what you presented there was very, very valuable. And we received a lot of feedback of what you presented. And since then, we said, okay, let's bring you to the Fivers audience. You have, I don't know many traders that have the years of experience that you have. You have seen everything. You have seen black swans, flash crashes, probably, I don't know, wars, and like massive events that, bull markets, bear markets, everything. So not a lot of time we have the opportunity to see it with someone like you with that experience, that have made it through the years consistently and making profits, and to ask the questions we wanted to ask to a veteran trader like you. So we have a very interesting topic today. I will leave that to you. Feel free to expand your introduction if you want to explain a little bit of who you are or what you do these days. And from there, it's all yours. I will mute myself, turn off my camera, but I'm here in the background in case anything is needed. And yeah, just lead us.
Okay, thanks very much. Thanks for the intro. And yeah, I mean, London was great. I really enjoyed sort of covering different things there as well. So yeah, for me, it's all about trying to help as many people as possible. So today we're just going to be sort of looking and devoting the time to technical analysis. We're looking at sort of candlesticks, but we're also looking at alternatives that there are when it comes to the technical analysis side of things. So I'm going to share my screen and then just take everybody through a PowerPoint. If you've got questions, you can ask them as we go along, but we probably won't get to those questions until the end. But okay, so I hope everybody can see my screen okay. So welcome to Symax Fintech and the Fivers, of course, that have generously hosted this for us. We're just looking at the potential for alternatives to candlesticks. So many people, such a higher percentage of traders all use candlesticks, and I'm one of them. But I use other charts as well. So, it's just nice to sort of have a refresher, or sometimes just to look at different things. Whether you end up using them or not is entirely up to you. But, it's just whether they'll fit in with what you've got already or maybe enhance it. But of course, what you want to be careful of is it doesn't actually take away from what you've already got. So first of all, just very quickly, our disclaimer. So trading involves potential loss risk capital, not suitable for everyone, although obviously I hope it is for you. And if there's leverage involved, just be aware you can lose substantially more than that initial investment. Obviously, if you're doing the trading challenges, it's great because you haven't got that risk there. All you can do is lose the account, which obviously we don't want you to do that. So again, just be careful with your trading and your risk management. Okay, so everything we do here is just educational purposes. We're not trying to encourage you to trade or invest. That must be your decision. And of course, you should consider the risks, financial situation, definitely your level of experience and your risk appetite. And of course, if you are risking your own capital anywhere, make sure that you can afford to lose that. Don't risk money that you're going to need over the next few months to pay some bills, that's for sure. And if you've got any doubts whatsoever, then just seek independent financial advice before you risk that capital. Okay, so we're going to start with sort of like the basic chart, which is just a line chart. Now, line charts are okay, but for me, really, line charts are very much more for investors rather than traders. you know, we're looking at those shorter time scales most of the time. Whereas, you know, if you're investing, if you look at that one, for example, to get into the, you know, if you wanted to put on a resistance line there, you was having to wait sort of 5-6 months to actually get that on there. Months. Okay, we're using a daily chart, but you get what I mean by that. And then when we look at the support line, okay, we could have got that within probably about 2.5, 3 weeks, and that would have been a great support line. But, you know, it's one of those situations where line charts do have some value, but for me, you know, just because we're using those closing prices each day, it's not really going to give me the intraday signals that I'm looking for. You know, I trade short-term, long-term. I've got a variety of different things that I'm constantly running, and I trade all different asset classes as well. Okay, so when we look at the line chart, it is limited. So yeah, it's more suited to sort of long-term investors. It does allow you to identify those long-term trends, though, although you might have to wait to get those good solid lines on to give you that. And of course, you know, it's when you get those support and resistance lines on, you know, you're either looking for 2 or 3 points touching on the way. And for me, I'm always looking for 3. I'm not that much of a fan of 2. But, you know, again, by having 3, that's giving me more confirmation. It's giving me more confidence to go into that trade. Now, you know, of course, you can tweak it. You can put it on a shorter time frame, but I still just don't think it's really that suited for us as sort of day traders. Now, you know, when we look at a bar chart, so bar chart's very simple, very clear. You know, we see in each session, we can see the lowest price it's traded, the highest price, where it opened within that time frame, and also where it closed. And, you know, when we look at that, it's very simple. And sometimes I must admit, I do prefer looking at sort of a bar chart sometimes, because with a candlestick, I get too attracted to the colors, you know, so I'm looking, but this gives you exactly the same information. The only difference is that the bodies just aren't filled in and colored. It does make it a little bit more difficult, though, if you're looking at some of the patterns that come out from using the candlestick charts, of course. And in here is this sort of analysis. So on the left, obviously, we've got the bar chart. On the right, we've got the same data, same time frame, everything. And this is the candlestick. So you can just see that it does give you that same information. As I say, on the left, I'm not distracted by the colors, but I use candlesticks every day for analysis as well. But so, you know, again, it's just showing you whether candlesticks are right for you. Bar charts give you the same information. Whether the colors distract you or not is entirely up to you to look at. So it's widely used. It does show price and time, which is important for many. And of course, you can tweak the time frame. You can have it from a minute all the way up to days, weeks, and months. And again, that's very important to, you know, make sure that the time frame you're using has some relevance to the time that you intend to stay into a trade. That doesn't mean if you're using a 30-minute chart, you should be out of your trade within 30 minutes. It just means that you're probably going to be out of it within 2-3 hours, generally, something like that. And of course, that, you know, the information we get from that bar chart is the high, low, open, and close. Again, we can get those trend lines on, support, resistance, you know, and it's so important to make sure you're really accurate when you're touching the bottoms or you're touching the tops of those lines, to make sure that you're as accurate as possible. Because even if you've got that slightest deviation, and you're not quite on that line and you're just slightly out one way or the other, it means that you could end up, you know, getting in too early, or maybe not getting in at all. Or that difference of that slight fluctuation could be the difference between staying in your trade or getting stopped out before the market turns and moves in your favor. And, you know, if you're already trading, you'll appreciate this, that the majority of your trades will go against you before they go for you. It's just a matter of how far they go against you before they turn around. And of course, you know, inside bars, you know, when we're looking at that, maybe that lower high and that higher low. And of course, you know, those types of things, we use them because we're then expecting a breakout. We can then use that high and low. So if it breaks above that on the next bar or next candle, then that can be a trigger for us to think that the market's breaking out in that direction and then act on that. And of course, with majority of charts, not all charts, but with the majority of charts, you can get a gap that's created. Now, you know, when we get these gaps, how are they created? It's usually a very quick price adjustment, and the majority of them come in the overnight session. So, you know, if you've got that overnight session, maybe it's closed just for an hour or less, then when it reopens, the price is adjusted, and then that forms the gaps. And of course, those gaps become targets for traders in the future. Sometimes those gaps will be closed very quickly. Sometimes it will take a long time for them to close. It could be weeks or months. And for me, I'm only interested in a big gap as well. I don't want to trade small gaps because I want the market to come in enough to convince me that the sellers are going to try and close that gap. And I'm going to get out before it closes as well. So if there's only a small gap, then there's not much to be made from that trade. And it wouldn't meet my risk reward parameters. So for those of you already trading the candlesticks, you're going to know this, but for anyone that's joining that's new, you know, it's just going over the basics of them. You know, you can call them wicks, you can call them shadows, and got that upper shadow, so where the highest price has been and the lowest. And then we've got the body in the middle, which is sort of the opening to the closing price. If it's a green candle, it means that it opened lower and it closed higher in these circumstances. But, you know, that's what you're sort of looking for. And the red ones, obviously, it's closed lower than where it opened. Now, you know, it depends what time frame you're using, but for pro traders, you know, we're generally on a 30-minute chart or 4-hour chart or even a daily. So it depends again on our time frame for holding those trades. But the hour and the half hour actually become quite important. And the reason for that, because as those are clicking over into the new candle, if you've got a pro trader that's got a big position, he's going to try and get that first price of that new candle. You imagine the market's been going up. He's going to, and he's long, he's going to try and make that first print of that new candle on the offer so that he gets a higher price for the start of that candle, because he's trying to influence and encourage other buyers to come in. And then, of course, if the market carries on with that momentum, it gives him that opportunity to get out and take his profit. So it's a little pro trick that a lot of professional traders do use. Time frame is always going to be important. And, you know, when you adjust the time frames, don't the charts look so different? You know, you put it on a daily and you've got one trend, then you bring it into, say, a 4-hour and you've got a different trend. And even if you bring it into 30 minutes, so you're getting trends within trends all the time. And you know, sometimes if you bring it into a 5-minute chart, which, you know, I try and get my guys not to do at all. But if you did, again, you would still see even a different picture in front of you. So here's a candlestick, but what I've added here is something else. Well, it's not really something else, but I've just put a few markers on there. Something that I've noticed, you know, I'll be honest, I don't read books about technical analysis. It's not that I know everything, but I know enough to make me money, and that's good for me. But it doesn't mean you should ever stop learning. But so for me, I've got my setups and all that. But one thing I have noticed over the years is when you get these long candles, you know, you get those big moves, you know, maybe within a 30-minute or a day. What I've noticed about them is generally when you get a series of them, 1, 2, or 3 of them, you know, where the market's having an aggressive sell-off in this case, and it comes down, then quite often the market has sort of settle itself for a little while, and then you'll get the opposite move. It's like a mirror image. And if you look through the charts, you will see this so often on them. Now, when I'm looking at this situation, I see those long candles, and then I see that the market's just sort of going sideways for a little while. Then I'm always interested to see, when that next big candle's coming, if it's going to come, because the market could, of course, just carry on going down. And then when I see that market start to reverse and start to go up, that's when I'm really interested, because for me, my trigger point is going to be where I put that sort of black horizontal line across there, because that is the high of the previous long candle that was on the way down, that second long red candle there. When it breaks that, that's going to get me to go into a long position. This is just one of my strategies. I'm not saying you should do this. I'm just telling you, when I see this, how I trade it. So that's my trigger. So once it breaks through there, I would want to get long of that. And then my objective would be basically for when it reaches the high of that first red candle. So, on this instance, yes, I would have got a profit. I could have stayed in it and got more, but don't we see that so often on near enough all of our trades that we could have had more? But then, greed. So is it good or bad? And then, of course, it's had that sideward movement. But I just thought it's something I'd point out to you because, as I say, I don't know whether it's in any books or people have ever sort of discussed this before. But if you look back through the charts, again, different time frames, you'll see that you get these patterns so often. The important thing is what's going to be your trigger. The same as for any trade, any setup that you've got. What is your trigger point? What makes you enter that trade? And of course, what makes you want to get out of it? You've got to have that full strategy that, they've got to plan it, plan your trade, trade your plan. So candlesticks favored by the majority of traders. It does show that same information as a bar chart. Except that it's got the added benefit for a lot that it's got the colors in there, so you can easily identify whether the market was going up or whether the market was going down. And then, of course, you've got all those different patterns that you can look to identify. One for me that I like is a doji, where sort of you've got that open and close at the same price during that time frame, generally a 30-minute or more. And, when I get that doji, for me, it's indecision. So, I'm looking for that next candle to start forming. And then I'm looking for it to either break out above the previous high of the previous candle or the low, because, again, that is going to be my trigger to get into a position. I'm going to use one or two other confirmations. I'm not just going to purely use that. And for me, I'm always putting sentiment, what I feel about a market into that. And then, I've got 50 years in the market. So for me, it's also I'm combining all my macro knowledge, my macro outlook into a lot of my decisions as well. And then I'm looking for those double and triple tops. Again, if you've got it on a 1 minute chart and you get a triple top or a triple bottom, is that a solid signal? And of course it's not. But if you've got that on a half an hour or an hour or 4 hour chart and you're getting those triple bottoms or triple tops, then that's a much more solid signal. And again, for me, they're ones that I'm going to consider. I'm still going to do my risk reward and all my assessment first before I enter my trade though. Now, I don't know if any of you guys have ever looked at Heikin-Ashi, but you should. Now, I'm not saying use it for your analysis, for your support and resistance. I only use Heikin-Ashi for one thing, and that is market sentiment. And if you look here, so the top candles is a traditional candlestick chart, and the one below is the Heikin-Ashi. And, you can instantly notice that the one at the bottom's got much more consistency in its coloring as the market's moving. same time frame. There's the daily candles that we've got here as well. But you can see the consistency that flows through that. So it's telling you, or it's telling me for sure, where that sentiment is in the market. And, you know, there's a gap on the chart on the top one. And we don't see that on the bottom one. And there's a reason for that. And it's the way, and it's the difference between the two really, is the way that the Heikin Ashi is actually created. Its start point is always the mid between the previous candles open and close. So if you look at any of that, this, you know, as I say, it's why there's not a gap on the chart. But not only that, but when we look at this particular situation, you know, every candle, every new candle that opens is opening at the midpoint between the previous candles open and close. And again, that helps to give it that consistency. Now, that's fine. And, you know, it does give that consistency. But, you know, where you've got to be cautious is if you've got a flat top to that candle or a flat bottom to that candle, that may not be a genuine high or low. It's only if it's got a wick, that shadow, both sides, that you know that that's a genuine high and low, which is why you shouldn't use it for your trend lines, etc. You know, for me, it's just purely sentiment, market sentiment I'm looking at. And, you know, if you see it, you can see it so clearly. Whereas if you look at the candlestick above and you was in the trade just focusing on the candlestick, it could be confusing at times. You know, you've got short and the market starts to come down, but then you start to get one or two bigger green candles come in. It can spook you out of your position. It's like, oh no, it's market's turning now. But with the Heikin Ashi actually saying, no, you're fine. It's not changing yet. And you can see that all the way through. Even towards the sort of the front of the chart, we've still got two little red candles and then a gap and then two more little red candles. But you know, it doesn't really make that much difference. I don't include them if they've got really small bodies. So for me, they're sort of excluded, so that it's still a bullish trend that was going on there at the time. So, you know, you can use this to complement the candlestick. It's not to remove the candlestick chart, because the candlestick chart is great for all your trend lines and lots more. But where you're using the Heikin Ashi is just to put it on. And I tell you what, this Heikin Ashi will work on any time frame. Short term, you know, sometimes I will actually go into a 5 minute with a Heikin Ashi. It's not to trade off of, it's to show me what's going on sentiment wise. So, you know, if I'm looking and I've got 3 green candles, you know, an hour and a half, the market's, you know, the sentiment's building up. And then I get a 4th one starting, you know, that's showing me that, you know, that there's strong sentiment in there for buying. Then when you start to get a sort of a red candle form, then a second red candle form, then a third red candle form, then I'm really interested, because for me, that's now warning me that there's a change of sentiment going on in the market. But what I want to see is that third red candle close, and for all 3 of them to be red. Then that is going to sort of, I'm going to do a little bit more analysis on candlestick chart or one of the others that I use. If I can get a confirmation from them as well, then that's going to get me into a trade once I've done my risk reward. So for me, that's one of my major charts that I look at apart from a candlestick. So it's similar to a candlestick. It's very visual. You know, it gives you a greater consistency in the coloring of the candles. And, you know, for me, that helps you to identify the trend. It also helps you to identify when the trend is changing, which can be really important. You know, sometimes I'll use candlesticks to get into my trades, but I'm constantly going back to the Heikin Ashi to sort of give me that confirmation to stay in that. And again, then if I start to see that change in coloring coming, then that's going to make me think about whether I should start to exit some of that position. It depends on whether I'm using a daily or a 30-minute chart on the candles, the type of trade I've put on to how long I'm going to hold on to that for. So the emphasis that each new candle starts at the midpoint between the open and close of the previous candle. And that's important to remember that. And anything that's got a flat top or a flat bottom to it does not necessarily mean that it's a genuine high or low. So always go back to your traditional candlesticks for all of your analysis. For me, Heikin Ashi is just about sentiment, market sentiment. But for me, it does remove sort of a lot of the noise from the price action. And, I hope it helps you. I really do. But just remember, don't use it for any other form of analysis, just purely for seeing where the trend is. Now, point of figure is actually one of the oldest chart types in existence, but it's also one of the most forgotten. And, again, when I was oil market making, this is sort of like when I started to look at this, because I wanted to identify where I could see the resistance and the support in the market. And I was using candlesticks as well, but I found this one and I just thought, oh, this looks interesting. And I started to sort of, again, just form a strategy by using this. So I created my own setup, my own trigger to get in. And I also sort of established a very simple way to manage my risk with it as well. So, if I'm going in and I'm going short, so, what am I looking for with this? Okay, I'm not looking for those sort of diagonal lines, trend lines, or anything like that. All I'm looking for is pure support and resistance lines in front of me. And to get them, all I'm looking at is where I've got something like here, I've got a triple top. So I've got 1 cross, 2 crosses, 3 crosses here. The market's rejected that. And of course, the market came down. And if you look, you've got series where you've got circles, the 3 circles support, another 3 circles support. Doesn't mean they're not going to break through them. So if you look over to the left where we've got that series, there's 4 actually there. And then the market did come away from that. But then afterwards, the market started to rally. And this is where sort of it becomes important if you're looking at this, because it's a matter of how you establish where your stop loss would be on a chart like this. So for me, I've got this very simple series of resistance here. Now, if it breaks through that, I'm not going to get out if it goes through by 1 box, but I will get out if it breaks through by at least 2 boxes. Now, sometimes, depending on the product, sometimes when I'm actually getting out and it goes that 2 boxes through, and I saw that as a very strong resistance point, I will actually reverse my position. So, I'd go from having a short position down there to stopping myself out, but also buying twice as much as I sold lower down. And then I've gone from being short of the market to being long of the market because it's had a breakout. And for me, that's very simple. So just 2 boxes. Now, the value of each of those crosses and each of those circles becomes very important. And because you can tweak it and adjust it as well. So on here, it's a 3 by 3. So the first 3 means that the value of each of those crosses and each of those circles is 3 pips. So if you've got 10 crosses in a row, it means the market rallies 30 pips. 5 red circles, 15 pips. Now, when the market reverses, this is where the second number comes in, which is another 3, and it's the amount of boxes that the market has to go in the opposite direction before it will populate anything. And so 3 3s are 9, but the market would actually have to move 12 pips in the opposite direction because it doesn't include the top box. So, as you can see on there, if you've got a cross there's nothing level with that. The three circles come in below. So that wouldn't be a 9 pip reversal. That would be a 12 pip reversal. And so when the market reverses, you get that initial 3 circles or 3 crosses established. Each time the market goes up another 3 pips, it would add another cross or another circle, and it keeps building and building and building until the market goes in the opposite direction. Now, if you look at the bottom, it's got time and the date there and such like, but point and figure is purely price action. They're just reference points. They've got no actual meaning, because point and figure doesn't react to time. You won't get a new set of crosses or a new set of circles form just because it's moved 15 minutes, 30 minutes, or an hour. Not at all. It only actually puts anything on the chart if the market's moved higher or lower. And what it's doing, it's condensing all that price action down. And of course, by changing the value of those crosses, you know, all those sort of smaller boxes, you can actually condense it more. Or if you've got a really, really volatile product, then you can actually make the value of each of those boxes bigger, which again is just sort of bringing it all back in. So it's something worth experimenting with. But, you know, all I'm looking for, I'm looking across that chart, I'm looking for horizontal resistance, horizontal support lines, nothing else. And then, as I say, I'm looking for those breakout trades if it should go through one way or the other as well. So again, something you might like, or it might be something, because it's so different, it might be something you thought, that's not for me. It's always your choice. You know, everyone's different. It's whatever works for you. Now, another one used by a lot of pro traders is market profile. And it's made up of the letters of the alphabet, and we can take a lot of information from it. And you can't sort of tweak the time frames too much. You either generally have a 30-minute, which gives you a day profile, or you'll put it on a 1 day, which will give you a 1 month profile. But we will take some information from that, like the point of control, the value area, and such like. So just to give you a better idea of what it's all about, here is market profile. So we've got the letters of the alphabet, and you've got sort of different things going on here. Each letter represents a 30-minute time frame. And what you'll notice is that if the market was to make a new high, those letters go above the previous letter. So it's always sort of building and forming, or below. And then when you get those sort of single letters on their own, then, you know, they're sort of unfair highs or unfair lows, and they're rejection levels, because the markets hasn't been able to sustain those prices. They've been there for less than 30 minutes. And then, you know, you've got uppercase and lowercase. They're representing the 2 sessions, morning session, afternoon session. And then when you get the most traded price of the day, you know, this first shape here, for example, is a real sort of day traders, our type of market, because the market's been lower, the market's been higher, but it's always felt more comfortable coming back towards that mid price. So, you know, big rally, you've sold it. Big sell-off, you've bought it. Of course, at the time, you don't know that's going to be the high or the low. So easy when we look back and see this historically. You're like, God, why aren't we all billionaires by now just looking at these? But, you know, the fact is that while it's forming, you know, you've got to identify what's going on as it's happening, of course. Now, this blue line to the right, this just sort of this vertical blue line, this thin one that's on there, that's the value area, and that accounts for 70% of the market activity at that particular point of the day. And then something else that we'll look at is the opening range of the day, the initial balance period. That's the first hour of trading we're looking at there. And then what traders will do, they'll take that first hour, they'll look at the highest price, the lowest price, maybe it's moved 25 pips, and then they will start to gauge and build resistance levels based on that and support levels based on that. So from the opening hour, if it's moved 25 pips, their first sell order will be roughly about 12 pips above the high. And then it will be 25 pips above the high and then 50 pips above the high, and the same for below as well. And, you know, that point of control is the most traded price of the day. And then we've got these horizontal bars just to the right of that. And what they are, that's a volume profile. So that's demonstrating to you how much volume went through at each of those prices. Now, something that's a little strange is if you look at this first profile, most of the volume, or the biggest amount of volume at any one price, went through much higher up than where the point of control is. And yet, if you look at the second two, where you've got those sort of most active areas within a price or two, is where you've got the most volume goes through as well. So this is giving us insight into what's going on within the market by using not just price, but also volume. There's a book on this, a PDF. It's 365 pages. So, you know, you can go a bit deeper into that. So the dark profile is the volume profile. It's just showing you how much is traded at each of those prices during the session. And also that blue line that was going through, the horizontal one, that's what we call the VPOC, which is the volume point of control. And we're always looking at those points of control because they are attracting the market constantly back to that price. So I don't know if many of you are familiar with Renko. So for me, Renko is like a modern day point and figure chart. Where the subtle difference is that with point and figure, where it has to move 3 blocks or 4 blocks to actually put anything onto the chart, and then, you know, it's going to grow from there one way or the other. With Renko, it's much easier formed. It's just a matter of when the market moves 5 pips up or down from forming that previous block, it will just add another block. So where with the point and figure, you wouldn't have less than 3 in a column. Here, you've got quite often just 1 in a column. But, you know, you can, again, sort of look to identify trend lines from that, drawing your support and resistance on, or just, you know, just trying to look for areas of interest there. So again, you know, I'm just throwing it at you as if it's something you might be interested in. So when we look at indicators, so, you know, when we're looking at something like RSIs, now, I don't know if you guys use this, but just be a little bit careful with RSIs because, you know, with FX, with all the different asset classes, we're seeing those bigger moves coming into the markets at times. And when they're happening, you know, you get that overbought situation or that oversold situation. You think, oh, look, you know, the RSI is above 70. Okay, it's above 70, but I've seen them go up into the 90s. You know, oh, it's 20 or 30. I've seen them go into single digits. You know, and so you just got to be a little bit cautious when you're using the RSI. And for us, so first of all, I like 80-20 rather than 70-30 because I'm a fairly cautious trader. But then the second thing I will do is use the 70-30 levels. So that if it's been up above 80 and it starts to come back down, then that when it breaks that 70 on the downside, that can actually be a trigger for me to get in. So we've got that hook forming. Now, the one thing to sort of always remember when we're looking at sort of these types of momentum indicators with RSI, for example, here, is that if you look, the market's almost gone sideways, but the RSI has dropped quite quickly. So again, just make sure if you're going to use this, you use it with a candlestick chart. You're using it with one or two other things to give you those confirmations. Don't just say, oh, look, RSI's got to so-and-so point, I need to sell it or buy it, because that's not going to work. And as I say, if you look for that hook, but even that hook's not always going to be enough. You need something else with it, because that hook is telling you that the market's going to come off. And of course it did, but it didn't come off until, that 30-minute candle. So it took about another 9 hours before that market actually dropped. I love Fibonacci. I really enjoy it. Again, if you understand how it was built and etc. But if we just look at it very clearly and very simply here, so we've established the trend, and we've established that the fact that the trend has ended and the market started to come back. So we've got the A where it started from at the low, and we've got the B where it sort of rallied up to, and then it started to come off. And then now we've got these effectively, as the market's coming down, these support levels. The green one is the first one, 382. To be honest, not that much of a fan of that. The 50, I take a bit more notice of, although I always give myself a little bit of leeway below the 50 if the market's coming off. And of course, the key one is the red one, which is the 618, which is also called the golden ratio. Now, analysts will be, if that market's coming down to there, a lot of analysts will be buying in front of that 618, because they're still expecting that to be a retracement. And of course, this is what the market, this is what it's telling you about the market. Is the market retracing, or has that trend finished, and is the market actually reversing? Now, I love to trade the golden ratio, because I will buy just in front of that red line. But when it breaks through, again, I've got to work out where my trigger point's going to be. So my first stop loss is going to be a financial stop loss of how much I'm prepared to lose, which I've already calculated in that trade. But again, this becomes another one of those reversals. Now, don't think reversing every single trade will get you out of trouble, because it will not. It will probably get you into more trouble. So be careful when you use this. So for me, where my trigger would be to actually then take on a short position would be when it would break these candles just to the left, just below the 618. When it broke the low of the lowest one of those candles there, that's when I would sell it. So, round about 15,900, something like that. And then, I would do that because I would then expect it to come all the way back down to A to retest where the whole trend started from. Doesn't always do that. It's a great thing about trading, or not so great, is that it doesn't always do what you expect it to. Sometimes you can get those little false breakouts. And then, of course, that can be a little bit problematic. Now, I don't know if you're familiar with pivot points, but, we as pro traders have used these for absolute decades, going back into the 80s. And, what we're looking at is sort of just looking at yesterday's data to provide us with levels for today. And it will take in either the high, low, open, close, or it will just take in the high, low, close. And then you divide that down by 3. And then there's a specific sort of formula that you use to create these levels. But you end up with a series of resistance levels and a series of support levels. And, if you look on it, I mean, just on this chart here, even, there's some good opportunities. This is the pivot point, the thick blue line, the solid blue line is always the pivot point. And, it almost got down, it tested S1, so the first support level, rallied up, got just above the pivot there, and then rejected that, came all the way down. This time it broke S1, almost getting down to S2, didn't quite make it. And then, where you see sort of it goes along and then you get that sharp line up or down, in this case, they're all down. That's when you're starting the new day. So, and again, that's why you've got new pivot point levels. But as you can see from the second one, it's sort of found a lot of range. It's for sort of at least half the morning. all it was doing was going between the support, the pivot point, and R1, which is the first resistance level. So what it's actually giving you is just zones. Each two lines, you know, whether it's R1, R2, or pivot point, or S1, S2, when it's between them, it's just giving you a range to trade until it breaks out each time. But they can be really good levels. You know, you base these on a 30-minute chart. And again, if you look at the bottom of day 2 there, it sort of rejected that. And of course, you know, the next day when it opened, it just went up and up. And of course, the following day, then it did crash and it went back down. But again, tested S2, rejected it, and then moved all the way back up again. So again, something to look into. You know, I'm not trying to convince you to use any of these. I'm just trying to show you a few different things that are out there that you may not have considered. You know, it's always great when you find something you think, oh, this is really good, I'll keep using this. And you do that, but sometimes there's something that's great out there, but you stop short, so you never get to great. And you know, that can be just something that's missing. That can be like the secret ingredient that really pushes you up onto that next level of trading. This is just purely breakout trade. We've got our trend lines in there. The market's broken above. Now, you know, when the market does break, the market quite often loves a retest. You know, it'll go up and it'll come back and test that line, that resistance line that's now become a support line, before it goes up again. And again, if you've missed that first breakout, it does give you an opportunity to get long when it does come back and do that retest. It doesn't always. And again, you know, if you're trading in that range, where's your bias? Your bias has got to be on the long side. Now, if I get long on that support line, I'm going to hold on to that trade and I'm going to get the most I can from that trade. If I'm selling at that resistance level as the market's going up into that sort of bull trend there, I'm going to be more reluctant to hold on to those positions and I will get out of them quite quickly. You know, I might even miss it because I'd probably look for half of that. But, you know, just again, just be careful. If you've got that uptrend coming, you know, your bias has got to be really to, if you get long at the support line, it's much safer, if there is such a thing in trading, than sort of selling at the resistance line because it's an upward trend. So with your trend lines, you've got to be accurate. You've got to have them as tight as possible. You know, if you think about it, you know, this is your start point. If you deviate from that start point and you was walking in a straight line, say 5 miles, by the time you were supposed to end up sort of here, you wouldn't. You'd be well over there or well over there. So, you know, it's the same with those lines, those trend lines. You've got to have them just touching those 3 support lines or 3 resistance lines and get that as accurate as possible. As I say, that can be the difference between getting a profit or being stopped out of your trade. So, you know, never take that for granted. You know, I would actually use a magnifying glass, even though I've magnified it up on my screen. I want to get them as accurate as possible because even 1 or 2 pips can be the difference between staying in that trade. So when we look at the advantages and disadvantages, you know, pros, easy to use, easy to identify opportunities. You know, I always say the fundamentals drive and determine trends, but technical analysis is great to help us with our timing and give us that visual aspect of what's going on in the markets. So we've got that visual aid and it's helping us. It helps us to improve our time. We can identify where the market should turn. Of course, it doesn't always, but we can see where it should. And then, of course, for the cons is other traders can see and guess where your positions are, and that sometimes that can make you a target. You know, if you've got that sort of golden ratio level, but fundamentals are driving it down, then, you know, sellers know that eventually that support's going to break and then it's going to have a big move on the downside. And of course, the other thing is that majority of time it does, but history does not always repeat itself. And if it does, it doesn't always repeat itself within the amount of time that you've got or within your risk parameters. So as I said, so fundamentally, I would say, the fundamentals determine trend and to a degree volatility. Macro rather than the micro. They do provide you with that long-term outlook of where a market's going and give you a bias though. You get that broader view of where the market is heading. But it's less valuable for short-term trading. With the technicals, we use in the past to help us predict the future. Nice and easy to use, clear signals. We've got our trends, we've got our breakouts, we've got our support, we've got our resistance levels in there. And of course, we can use some other indicators. It does help us to assist with our timing for our entries, our exits. Also, it helps us to identify where we need to place our stop loss. And of course, if it goes wrong, we've got something to blame. Oh, it was the chart, it wasn't us. But of course, it's always us. This is a trading diary. I don't know if you guys keep one, but you should. Even after 50 years, I still do this. I write down all my trades, time I got in, blah, 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 blah. But it's great for self-analysis. We're analyzing the markets every day. Why shouldn't we analyze ourselves? Where can we improve? Because there's always room for improvement. And I've got this as an Excel sheet. If you're interested in a copy, then there's the details, info@symaxfintech.com. I'll happily send it to you. And, you can go in and tweak it and make it your own thing. But trust me, it will help you to improve your performance. You'll be able to identify, where some of those little weaknesses are, if you've got any. But it will also highlight your strengths. And of course, that's something that you want to build off of. If you are interested in doing any courses, because it's something that we do, there's a discount code for you there, SF5/07. And this will entitle you to 10% from our courses and masterclasses. If you're a female or over 50, we'll actually give you an extra 5% off there, because we'd love to see more of you in the market. We can't use it with any other offers, and it's valid until the end of September. Very, very, very quickly, because I know I'm sort of going on and on here. Apologize if you need to do something else. We do weekly YouTubes. We do a daily newsletter if it's something that's going to be useful to you. And course-wise, we do one-day workshops, 1 week courses, comprehensive courses as well. Trader mentoring just to help you get to that next level. We consult to companies to help them with their hedging for their FX and their commodity exposure. We provide a load of educational content to a variety of individuals, exchanges and brokers. Then funded trading accounts, of course, and we add some of them on to those courses as well, and then give a free challenge at the end of that. So, if you're trading, always make sure you've got your broker's phone number and account details handy, just in case you lose connectivity. If you want a copy of these slides, it's no problem, although it's being recorded, so you'll naturally have them anyway. And that just leaves me to say thank you very much. I hope you've taken something from that. If you've got any questions whatsoever, feel free to reach out to me.
Yeah, thank you, Chris. It was very insightful. I myself learned about some new charts that I'll check deeply. Let's see if there's any question here from the traders. So let's just give it a minute. I think I saw one before, and if not, let's give it just one minute.
Kelvin Wilson's raised his hand.
Okay, Kevin, yeah, please send your question. Let's see if you... And if not, of course, we're going to all the sessions has been recorded. We're going to upload it for to the YouTube channel, and you will be able to contact Chris as well. I'm going to leave his contact details, and it's going to be also on the VOD on our dashboards. You're muted. I want to speak. Let's see if we can allow to speak. There you go, Kevin. I think you should be able to speak now.
Yeah. So please, I wanted to ask if I saw a message in the chat box that it's good to study the Wyckoff method and the other flow other than the SMC. So what's your take on that, please?
Yeah, I mean, with the sort of all the flows really important because you're seeing whether the buyers or the sellers are being more aggressive in the market, and of course that is going to overall sort of determine the trend and how far the market's going to go. And again, you can use volume for that as well, because if you're getting a build up of volume and then the volume suddenly drops off, when you see that drop off of volume, that's quite useful, because that sort of that buyer in is sort of petering out, and then you're sort of waiting. If you get low volume bar after that, then that tends to sort of suggest that the market's about to reverse as well. But overall, I think that it really depends on your style of trading to sort of how you're going to come in and use the indicators and charts overall. I've got a variety of different ways that I trade depending on what I'm trading and how long I'm expecting to hold those trades for. So I don't know if that answers your question or not. Do you want to unmute yourself again, Calvin?
Okay, so how do you see indicators? Are they 100% to be used, or can you use them for your confirmations, or you should add the other ways, or you should base on indicators for most of your confirmations?
I would only use an indicator as a confirmation. I certainly wouldn't use it as my main decision tool. If I've got one, maybe two things that are telling me the market's going to go up or go down, I might look at an indicator to give me that sort of third confirmation. Now, every trader's different. Everyone creates their own setups as such. When it comes to indicators, pro traders will only use maybe one or two selected ones that they're familiar with and that work for them. They won't have a whole range of them that they're looking at. So again, it's about finding what's right for you. What's going to complement what you've already got as a setup. So I mean, obviously I would guess you're using candlesticks. How do you sort of, what's your time frame for trading?
Normally my time frame for the trading, I do my confirmations. I draw down from the weekly time frame, then I draw it down to the daily time frame, then I make my trades on the 4-hour time frame, please.
Okay, that's good. Yeah, and that means you're holding on to those trades longer. And for me, the longer the time frame, the more solid the signal is going to be. I'm going to be more confident going into a trade that's on a 30-minute or a 4-hour chart, than a 5-minute or a 15-minute. When I'm doing courses, I try it, and apart from sort of showing that Heikin-Ashi as a trend thing, sentiment, then I try and stop anybody going below 30 minutes. But 4 hours, dailies, weeklies, all good, really strong.
Okay, so basically I should be using the candlestick confirmations to and like in addition with my confluences, right?
Yes, yeah.
Okay, because I read an article that was saying we should normally use indicators for confirmations.
yeah, that's all they're for, is just confirmation indicators. You shouldn't be using them as your main signal.
Okay. Okay. Thank you. Thank you very much.
Welcome.
Okay, Chris, I see some messages of great session, and thank you very much, and enlightening. So I think it was, and I think we'll wrap up here the session. So thank you, Chris, very, very much. We'll upload this to the YouTube channel, to our VOD. Your contact details will be there. I'm sure some traders will contact you directly. Thanks, guys, for coming. Thanks for staying always. Danny, Oscar, thank you very much. And thank you, Chris.
Yeah, thanks, guys. I hope you enjoyed it. Sorry it was a little bit fast. If there's anything you want a little bit more information on, then just feel free to reach out to me. Happily provide it.
Fantastic. Thank you, everyone.
And thank you to the 5ers for inviting me.
It's a pleasure.